This is your mortgage rate watch for Tuesday, February the 1st, and I'm Keith Akada with the Mortgage Reel. Taking a look at the bond snapshot to the page today, we really want to go over what's happened since the beginning of the year. You'll see that we started the year off pretty good, and then all of a sudden we have all these red radical marks that represent interest rates moving higher. And what that really comes from is economic data coming out here, quantitative easing too, don't forget about that one. And then globally, what happened with Europe, Portugal, France, Spain, and now with Egypt. Whenever that happens, we see the move back into the U.S. safe haven market, improving mortgage rates. But the key thing here is there's been a lot of volatility, but we've been able to maintain some support. But the key factor is looking at where we're going into the future, going into this summer, it does show the gradual rise of interest rates. We'll explain more why now. Here's a great example with the crisis in Egypt. On Wall Street, at least the traders are all thinking that this crisis, even though it's far from over, is not going to escalate in more violence. So the safe haven market in the United States is starting to thaw out its sentiment, and that money start to move back overseas into foreign markets. With those funds moving out of the United States safe haven markets, and companies like UPS, our brown shippers that we all know, coming out with blowout earnings, it really shows that the volatility comes back into play. And what we're seeing today is the market worsening because Wall Street again up and trying to test that 12,000 point barrier. One of the main points that we would like you to take away from today's post is we're talking to the investor, the current homeowner, the future homeowner. What's happening through this year, even though they're talking about the double dip housing prices and what's going on with banks and robo signings like Bank of America and Wells Fargo, is that rates are going to gradually move higher. And why is this? It's because global economic recovery and growth continues to expand, both locally and abroad. And with expansion, it pressures everything in the market to move up. But don't forget, key point here, 2009 and 2010, we had the Federal Reserve that came in to back and keep and sustain interest rates to be low. And how do they do this? By implementing and putting a ton of money in the tune of $1.3 trillion into the markets to purchase long-term bonds to sustain low levels. But here's the total difference moving into 2011. 2011, quantitative easing 2 came out. And with the main point of quantitative easing 2, it's to boost stock prices higher, create inflation, and lower the unemployment rate. When you create inflation, that is unfriendly to the bonds and unfriendly to the mortgage market. By creating inflation, we have nothing to look forward to other than higher rates. And we're always seeing the impacts of inflation at the gas pumps and what they're predicting for gas to be this summer with the cost of travel, the cost of just getting from point A to point B. That's all sign of inflation. Here again, unfriendly to bonds. So the key saying in Wall Street goes, don't fight the Fed. And with that saying, with don't fight the Fed, people cannot go into the same mindset that quantitative easing 2 is going to have the same effect on mortgage rates as it did in 2009 and 2010. It's going to have the total opposite because it's creating inflation to boost the economy, but that is very bad for interest rates. More to come from Homeowners Education 101 as we put the final touches on the 2011 forecast for housing and mortgage rates. Leave any comments or feedback below as it's not only appreciated by Team Mortgage Reel, but also by current and future viewers. Join the conversation on Facebook at How to Beat the Banks and like us when you're there. Otherwise, we'll be back tomorrow with more updates on your Mortgage Rate Watch.